The nuclear energy sector has been through a roller coaster year. While stock prices have faced pressure, the underlying fundamentals are stronger than ever. Investors who bought at the highs last year have been hurting. Many are wondering if the nuclear story is still intact or if the hype has faded. But as experienced investors know, a disconnect between price and fundamentals often signals a historic opportunity. Let's dive into why. The biggest driver right now is the massive build-out of AI data centers. These facilities require immense amounts of 24/7 carbon-free power. Tech giants like Meta, Microsoft, and Amazon are leading the charge. They aren't just looking for energy, they're looking for stability and scale. Meta recently sought proposals for up to 4 gigawatts of nuclear capacity. That's a staggering amount of power for a single company to request. The International Energy Association predicts that US electricity demand will effectively double by 2030, a trend driven largely by AI. Meeting this demand is the challenge of the decade. Renewable sources like solar and wind are part of the solution, but they aren't enough alone. Grid stability requires baseload power, energy that is always on. This is where nuclear energy becomes the indispensable foundation. To meet this surge, the industry is moving on two fronts: traditional large-scale reactors and the new small modular reactors, or SMRs. Traditional reactors produce massive amounts of power, gigawatts at a time. They are the workhorses of the existing nuclear fleet. Historically, building a reactor has been a decades-long endeavor. One US plant started in 1972 wasn't finished until 2012. An unacceptable pace for modern tech needs. SMRs are different. They are designed to be built in factories and deployed in smaller footprints, making them ideal for data centers. Instead of gigawatts, SMRs produce megawatts. This modularity allows tech companies to place them right next to their server farm. However, SMR technology is still a few years away from full commercialization. Most projects are targeting the early 2030s. The main hurdle has been regulation. US standards are among the strictest in the world, often slowing project timelines to a crawl. But there's a major shift happening. The NRC is now moving from just being a gatekeeper to actually facilitating project growth. This policy change is designed to accelerate the deployment of advanced nuclear tech to meet the urgent national energy need. Now let's look at the stocks. Our first pick is Constellation Energy, the largest provider of carbon-free energy in America. Constellation is uniquely positioned because they already have a massive operating fleet that can be optimized for the AI era. A prime example is the historic deal to restart a unit at 3 Mile Island, specifically to power Microsoft's data centers. This is the new reality of energy partnerships. They've even acquired natural gas plants to ensure they can provide reliable power while their long-term nuclear expansions are built. Investors often compare CEG to a Warren Buffett-style stock, stable, dividend-paying, and providing an essential service with a deep moat. With a PE ratio around 22, CEG offers reasonable value for a company with such strong growth prospects in a critical industry. Their dividend profile adds an extra layer of appeal for long-term holders, rewarding patience as the nuclear story plays out. For a higher risk, higher reward play, we look at Centrus Energy. This company is a critical part of the nuclear supply chain. Centrus is currently the only US-based company capable of producing HALEU fuel, which is essential for small modular reactors. Centrus's moat is its HALEU production. Since most enriched uranium currently comes from international sources, a US-based supplier is a matter of national security and economic strategy. This gives them a massive competitive advantage. If SMRs become the standard, Centrus holds the key to the fuel supply. They are already seeing revenue growth, reporting an 18% year-over-year increase last quarter as the pipeline fills up. But be prepared for volatility. As a smaller player, LEU stock price can swing wildly based on individual contracts and news beats. Our last pick is for if you prefer broad exposure to the whole nuclear theme and avoiding single stock risk. The VanEck Uranium and Nuclear ETF, ticker NLR, is a strong alternative for diversification. NLR holds a basket of the industry's biggest players and innovators, spreading your risk across the entire nuclear ecosystem. Investing in the ETF lowers the risk of a single company failure, but remember, the entire sector still moves together. Remember, the stocks may move based on news today, but the cash flow from these projects is a decade away. Patience isn't just a virtue here, it's a requirement. The most important factor is your time horizon. This isn't a short-term trade, it's a 10 to 15-year growth story in the making. Even Amazon's energy strategy team has stated that nuclear power is the most credible path to scale carbon-free energy. While the recent sell-off has been painful, for those with a long-term view, this looks like a historic entry point for the next energy age. To recap, AI is driving demand, SMRs are the future of tech, and stocks like CEG and LEU offer two ways to play it. Scan the QR code on your screen now to access our detailed report and stay ahead of the energy revolution. Thanks for watching.